Having the power or the peace of mind to pay off your mortgage earlier. Aaron, 30 years of age, engineer, he's going into a mortgage, and the mortgage is $1.5 million to age 60. Now he's borrowing $1.5 million, so he's taking out a life insurance for $1.5 million. If anything was to happen to him, this cancel this loan or this mortgage. Now, traditionally, what tends to happen is people tend to use term insurance. However, he wanted to use a cash value building type of policy. And in this situation, we just use an endowment. But he could have also used a whole life as well. So with the endowment, $1.5 million to age 60. However, at age 60, he gets the $1.5 million as well as the property will be paid off for. Now, let's fast forward and in terms of the thinking behind doing it like this. So let's say Aaron is now 55 and a few things could happen. Aaron could suffer a stroke and may be unable to work. He may want to pay off that mortgage earlier. His employers could say his position has now become redundant and he could lose his job. He will want to pay off that mortgage earlier. Aaron's wife could become sick and he could decide that he wants to retire earlier and take care of her. He may want to pay off that mortgage. The economy could take a turn for the worse. He may want to pay off the mortgage. He may want to go into early retirement. He will want to pay off the mortgage. His legacy could be that he wants to leave the property in his son or daughter name. He will still want to be paying off the mortgage. But at 55, he will still be owing $464,000. But because we did this, at 65 or at 55, he can withdraw from the life insurance policy and pay off the mortgage. Now, he may not have saved on the interest, but what he does have is peace of mind. And the thing about it is, plans that offer long-term benefits, because this is a long-term plan. It requires a different approach from those that provide short-term access. So you see, when we as individuals have easy access to funds, we often find reasons to spend it. Think about it. One of the things persons may say is that he could have taken money from his savings and dump it onto the mortgage and pay off the mortgage with the same effect. But the thing about it is, what Aaron realized with COVID, life is unpredictable, and Aaron rather hold on to his liquidity. Because if it is you start dumping money onto the bank to pay off your mortgage and using your savings, if something was to happen, you may not be able to get that money back from the bank that you was putting towards it. So you rather have a long-term plan to pay off his mortgage earlier. Now, the monthly contribution for something like this for a healthy 30-year-old is roughly $2,000 a month. It's not for everyone, but it's something that persons can consider in terms of planning in the long term, especially when it is going into a mortgage, especially if it is going into a mortgage to age 70. You will definitely want to pay that off earlier. Right? Hope you guys saw value in this. Like and comment if you have any questions.